Everyone dreams of making money the easy way, by letting the work of others earn it for you through investment. Further, with cryptocurrency more mainstream than ever, the stock market flourishing as always, and more small-time investors joining the fray, now is one of the best times there has ever been to try your hand at living like the so-called 1%. But how are you supposed to do that exactly? Here is a list of ways that you can learn how to invest like the 1% and start living life on your own terms. So watch this video till the very end to find out how. Don't be afraid to shoot for the stars. If you're one of the millions of people in this world who have dreamt of joining the 1%, those being the people walking this planet that own 45% of the world's total wealth, then one of the most difficult things to deal with is the daunting feeling that it is nigh on impossible. No sooner have you pictured yourself sipping champagne on your mega yacht, then you remember that you have bills to pay and no idea how to begin. Well, actually, you won't believe how possible it is. Look at the world's most successful investors, like Warren Buffett and Bill Ackman. They didn't start out successful, of course not. They learned from the likes of Benjamin Graham before them. So it's worth betting that with a bit more understanding about how the 1% invest, you'll be much better equipped and have a way better shot at putting together your own successful portfolio, as well as being ready for potential dips in the market. And just like Anthony Robbins says, success leaves crumbs. But what is their secret? Well, here's the thing. The 1%ers don't have one, as you might consider it. They invest in much the same way that you might, in regular stocks and bonds. Some might be better than others at picking the likely winners, but there's also plenty of luck. One thing that does separate them from the regular Joe investor, though, is the alternative investments they make into things like fine art, real estate, more on that later, and private equity. These markets have been fairly closed off to all but the hyper-rich until recently, but with more and more fintech, financial technology platforms becoming available, and with the broadening of investment managers' horizons, investments like these are becoming more available to the other 99%. But why are these markets so popular, and how can you get into them yourself? Well, funny you should mention that. 99% problems. Let's imagine a fairly typical 30-something investor. They're in their 30s probably, and their investment portfolio might be about 60% invested in stocks, which are usually a pretty high risk since their values can rise and fall about as regularly as cryptocurrency once Elon Musk starts and stops tweeting about it. So there's really no guaranteed income from these at all, and the other 40% of their portfolio is likely to be in bonds, which are safer, especially those issued by major governments, which can create extra money if necessary, as well as repay debts in full when they are due. It's handy to diversify this way as losses incurred through investment in stocks are offset by the gains from bonds. And with this kind of rebalancing, for example, investing the profit from winners back into losers, investors typically do well over the longer term. But that's not how the 1% operate. You'd be amazed how differently they invest. A 1%er will of course have some standard stocks and bonds in their portfolio. But the thing that sets them apart, as mentioned earlier, are the investments they make in a wider variety of alternative markets, like real estate and collectibles, such as artwork. They also invest in high-risk hedge funds, private equity, and venture capitals, etc. As with the golden rule of investing, being allocation, allocation, allocation. The best advice you're likely to get is to invest around 20% of your overall portfolio into alternatives. That might vary, of course, as not everybody has the same circumstances. This kind of diversification can really help your portfolio out when it comes to handling major market downturns. And since nowadays there is much less barrier to entry on alternative investments, thanks to fintech that offers you a way in, there's less reason to ignore it as an opportunity. Real estate. So let's look into one of the biggest groups of alternative investments that offers both comparatively lower risk and many real-world benefits. Of course, it's real estate. Property in general is seen as slow and fairly stable, a bit like a house. Since it isn't directly traded on exchanges, the companies owning said property can be. In general, though property is fairly immune to price swings and certainly exempt from daily fluctuations. As an example, the value of U.S. commercial real estate remained fairly stable in 2018, and investment rose by 15% in the sector. At the same time, U.S. residential real estate such as houses and apartments increased by roughly 5% on average. The value of land in the U.S. has increased over time, and everybody knows this to be the case. It has also meant an increase in real estate value, of course. Since 2008, house prices have risen just under 35%, and in San Francisco particularly, they've doubled. Not amazing enough? Check this out. The US stock market has risen 300% since then as well, though investors likely took much greater risks. Now, when you imagine investing in real estate, you are probably thinking that you buy a profit sometime later. But actually, the 1% invest in real estate differently, without having to stake great big wads of cash on a down payment. Real estate investment trusts, REITs, have, since 1960s, allowed people an easier way to invest in real estate. Plenty are listed on the stock market, and they're required to distribute 90% of taxable income to investors as dividends. They're a very reliable form of income, but not your only option. Investors who wish to stay clear of the stock market can try a private real estate fund, which centers around pooling your cash with other investors to put on a property. A team will manage the investment for a fee or a portion of profit, and investors can simply tie their money for a set time limit, which limits liquidity, far more so than REIT, which is publicly traded. But thanks to real estate lending and crowdfunding, it's not only the 1% who can join this party anymore. Private equity, art, and hedge funds. Who doesn't love art? Only some seriously weird people, that's for sure. While collectors can't trade sculptures and paintings in the same way as a stock or bond, art is an asset class by itself. Art investment in the US alone is expected to reach $2.7 trillion by 2026, and 5% of wealth managers reported their clients were asking for advice on investing in art and collectibles, as reported Deloitte's Art and Finance report in 2017. This is to say almost nothing of NFTs, which are taking digital art to the same arena as physical art, using blockchain technology, and we could probably create a whole new video on NFTs alone. Private equity firms and hedge funds are also options, as private equity firms invest in private companies or take public companies private by buying them out with money they themselves raise from investors. The aim is to grow a business and sell them on, while hedge funds are pooled investment funds that invest across a range of stocks, bonds, currencies, and derivatives. They are designed to generate profit for investors, whether markets rise or fall. The only trouble is that the latter two options tend to be quite high risk, and investors need to be accredited and wealthy enough to support the risk. Recap. By now, you could probably answer the question of what the 1% secret is. In short, it's diversification beyond traditional investments and into alternatives like real estate, art, and equity. It's also about ensuring the right percentage of your portfolio is in alternatives to offset losses from traditional investments. Real estate is a major area of alternative investment, and there are multiple ways to approach, from crowdfunding to REITs. Finally, look out for potential investments that won't get smashed by a broad economic downturn. You'll be amazed at what you can accomplish through diversifying your portfolio in this way. So have a think about whether you're able to diversify, what you are willing to risk, and which of the many areas of alternative investments might be right for you. Once you've done this, go for it, jump in, and see what options are out there for you. And soon, you'll know how to invest like the 1%. But the most important thing of all is to have the right mindset and be prepared to lose sometimes in order to win.